Hello students, hope you all are doing great. I'm Achal Chaudhary working as an assistant professor, BBA department in St. Andrews Institute of Technology and Management. So students, I'm back with my online lecture series of company accounts. So students, it's your lecture number 3 from unit 4. And in previous lecture, we have covered the valuation of shares. Today, we are going to start a new topic that is banking company accounts. Today, we will cover its meaning, various restrictions, and various schedules which is covered under the banking companies. So, we will discuss all of these topics in detail. So, let's get started. Meaning of banking companies. A bank is a commercial institution permitted to accept, collect, transfer, lend, and exchange money and claims to money both the domestically and internationally, and thereby conduct smooth banking activities. Basically, it's a kind of organization which is involved in the commercial activities, like it is involved in the exchange of money, giving and taking the money, and it is also involved in the lending the money to a person or to a company. So here all the transactions which is related to the money, whether it is to collect the money, it is related to the transfer or lending or exchange of money. So all of the activities, all these kind of activities are considered as your banking company transactions. So all the transactions are covered, which are covered and related to the money exchange. Those activities are related to the banking companies. Important accounting provisions of Banking Regulation Act 1949. First is your non-banking assets, the case in which the customer to whom a bank sanctioned loan against some security, and if he fails to pay the same, the bank decides to acquire such property kept as security to satisfy its claim. So students, what happened that whenever you are going to take a loan from the bank, then in that case what you do, you have to keep some security, any asset or anything you have to keep there as a security. And if in case you are not able to pay that amount, you are not able to repay the amount to the bank, then what they will do, they will keep that security to satisfy their claims, by which they will adjust their claims. So such property is known as your non-banking assets. So it's a like these assets are exhibited in the schedule 11, that is other assets. So it will be covered under the other assets. Next is your minimum capital and reserves. So section 11, according to the provision of section 11 subsection 2 of the Banking Regulation Act 1949, the following are the limits which are imposed on the value of paid up capital and reserves of a banking company. So whenever there is a banking company which is incorporated outside the India, in that case you need to be like there should be a minimum capital of rupees 20 lakh if that business is placed in the Bombay or Calcutta, and for any other city it is 15 lakh. In case a banking company incorporated in India, so in that case rupees 10 lakh for Bombay and Calcutta, and if there is any other place for the business, then in that situation there is a provision of rupees 5 lakh only. Restriction on commission, brokerage, discount, etc. on sale of shares. First, restriction on payment of dividend. Under section 15, it has been mentioned that a banking company shall not pay dividend unless all of its capitalized expenses have been completely written off. However,
a banking company may pay dividend on its shares without writing off, because there is no compulsion on that thing, because here it is mentioned that a banking company shall not pay, means there is no foundation regarding it, but it is preferable that it should no any company should not pay the dividend unless all the capitalized expenses are written off.
Next is statutory reserve. Under Section 17, it has been mentioned that every banking company should create a reserve fund by transferring to it at least 20% of its annual profit as disclosed by its P&L account before any declaration of dividend. That is known as your statutory reserve. Under Section 17, it has been mentioned that there should be a particular amount of, that is 20%, that should be kept as a reserve for the, you can say, for the future contingencies. So that reserve which we are keeping from the P&L account before declaration of any dividend, that is known as your statutory reserve. Next is cash reserve. Every banking company requires to maintain a balance equal to 3% with the RBI. So what you have to do here, you have to create a 3% of cash reserves for a for to meet the several contingencies which can occur in the banking industry. So for that it is mandatory to keep a cash reserve of 3%. Next is your restriction on loans and advances. So in this what happens that a bank can't grant loan and advances on the securities of its own shares and securities, or you can say loan or advance to on behalf of any director, any firm, company or any individual. So here the bank can't give the loans to such things, to such peoples, or you can say to such organizations or firms. Various schedules of banking companies. So students, there are various schedules which are given under the banking companies. So let's have a look on those schedules. First, Schedule 1, Capital. Capital is shown under the head of capital and liabilities. As you know that it's the first element which is shown under the liabilities side. Next, Schedule 2. Schedule 2 talks about the reserves and surplus. So here reserves and surplus includes the statutory reserve, capital reserve, any securities premium. So all of these are included in your Schedule 2. Schedule 3, deposits. So here any demand deposit, saving bank deposit, term deposit. All of these are included under the deposit side, which will be concluded under the capital and liabilities. Schedule 4, that is your borrowing. If there is any kind of borrowing with RBI, any bank or any other institution agencies, so all will be covered under the Schedule 4. Then Schedule 5, other liabilities and provisions. So basically it includes any bills payable, inter-office adjustment, any net adjustments, you can say accrued interest or any other kind of provisions. So all these will be included under Schedule 5th. And Schedule 6 includes your cash and balance with RBI. Any type of cash in hand, balance, any kind of balance with the RBI. So all of these will be considered as your cash and bank balance. So it is the first item which is mentioned under the asset side. Schedule 7, balance with banks and money at call and short notice. Basically, students, these includes in India balance with banks, that is related to current account, any other deposit accounts, money at call and short notice with bank or any other institutions. So it is also included under the head of assets. Next, Schedule 8, that is related to the investments. Investments here means the any government securities
that is related to India or outside the India. So that will be considered as your investment. Next is your Schedule 9 related to the advance. Any kind of advance payment that was like bills payable or bills purchased and discounted, you can say secured by tangible assets, advances in India or outside the India. So these are the kind of assets. Whenever you are paying any expenses in advance and you haven't taken any kind of benefit from that payment, that is known as your advance. So that is also kind of a assets for you. Schedule 10, that is related to the fixed assets. Here fixed assets include the premises or any kind of fixed assets. So that will be considered under the fixed assets. Schedule 11 is related to your other assets like accrued interest, tax paid in advance, any kind of payment related to the stationery stamps, non-banking assets. So these all are included as your other assets. And your Schedule 12, which is related to the contingent liabilities. These includes claims against the bank not acknowledged as draft, liability for partially payment investment, or you can say liability against forward outstanding payment. Schedule 13, that is related to the income. So students, here income includes interest earned through the advance bills or investments or any balance with RBI. So all of these considered as your income, and this is shown as the first head of assets. Next is your Schedule 14, that is related to other incomes. So here other income means like commission, exchange and brokerage, or you can say profit on sale of investment, profit on revaluation of investment, or any kind of profit which is earned from the sale of land, or you can say any exchange transaction profit. So all of these are included in your other incomes. Next is your Schedule 15, that is interest expended. So interest expended includes the interest on deposits, interest on RBI deposits, or any kind of any other interest which will be mentioned here. And last is your Schedule 16, which covers your operating expenses. So operating expenses are like all revenue expenditures and provisions. Like you can say rent, taxes, lighting, salaries, wages, depreciation. So all of these are considered as your operating expenses. These are kind of your day-to-day expenses. So these are covered under the P&L account on your debit side. So student, that's it for the like schedule things. Here all the schedules which are covered under the Banking Company Act, that all are we have concluded all of them, and we have covered all of them in detail. So students, that's it for today's lecture, and here is the question related to today's lecture. Explain banking company accounts with its provisions under company accounts. So here you have to explain this question in detail. You have to discuss it in detail. And still, if you have any sort of query or you have any doubt, then do let me know. I will arrange a doubt session for you. Thank you so much for your time. Stay tuned for more videos.